Hello and welcome to Skills to Pay the Bills and today's segment of JustAskFreeman.com. With me, your host, Freeman and Owen, Jr., and my co-host and lovely wife, Carolyn Owen. We are the owners of Financial Sources, Inc., and our purpose is to make sure that you are informed and educated about all areas of financial management and protection. Carolyn, what are we going to talk about today?
Well, people know we only have 30 minutes to share with our viewers, but we're going to try to cover these areas as best we can, touch upon them at least. Why women lack having enough life insurance? What is a 1035 exchange? We're going to cover bridging the gap between retirement and Medicare eligibility. We're going to also talk about what is an IRA rollover? What is required minimum distribution? Is there such a thing as self-employment retirement plan? And what is a Roth 401? And if we have time, we'll cover some more topics.
All right. Seems like it's going to be a pretty good show today.
Absolutely. We're going to try our best.
Let's get started.
All right. Well, we're going to start first with about why women lack life insurance. Well, Freeman, you know, statistics tell us that 59% of unmarried women with children do not have any life insurance.
Exactly.
Yes. Now, this seems like a critical problem to me, with the women not having any life insurance. So why do women lack life insurance?
Well, you know what I'm going to do, Carolyn, is separated the answer to your question into three different categories. Almost half, about 40% of all the women in the labor force contribute to the financial or family finances. So let's look at the first category. You've got about 37% of women who are working moms with children that are 18 earn more money than their husbands. You have about 63% who are working moms, and many of them earn less than their husbands. And then you have the stay-at-home moms. Now the task, or I should put a certain amount of income to that task, household task, contribute to financial stability of the household. You have what we have here, the income is around $59,682. It has increased. Now, I did notice that with this survey that was taken, 59% of the men have some type of insurance, but the size of the policies, when you compare them between working dads with children under 18 and working moms, is a great disparity. Women have their face amount of their insurance about $159,000 compared to working dads at $215,000. Now, the thing is, since we have a large category of women who are working and contribute to the financial status of the families, a good vehicle to use would be term insurance, which is pure vanilla. Term insurance offers no cash value, but it can be useful to have that type of insurance to replace income. That is very, very critical because it's very simple. You can take out term insurance. It's very low cost, but again, as these statistics show, many women are they're underinsured. And as you saw, as I mentioned earlier at the start of this conversation,
Yes.
40% of the working moms are contributing to the household as far as finances are concerned. So let's talk also about beside the coverage gap, let's discuss what a 1035 exchange is. Want to talk about that?
Yes, well, most people know that the 1035 exchange was named after Section 1035 of the Internal Revenue Code. But the same people usually don't know what it means, so Freeman, we need some education.
All right.
What does the 1035 exchange mean?
Well, this is relevant to the insurance topic we just discussed. If you have an archaic, outdated contract, annuity contract, or if you have an old policy that you purchased many years ago, circumstances change. For example, there could be divorce, there is death, or there's an addition to the family, children or grandchildren. This is where the individual will have an opportunity to exchange these old policies or annuity contracts for new ones, more of an update to facilitate and to help them with their particular needs that are current. Now, this is a non-taxable event, but you have to be very, very, very careful when you exchange these policies, simply because there may be surrender charges and other fees to surrender the policies into new contracts or into new policies. And the new policies, there are new surrender charges, there may be new expenses, etc. But the same contract holder has to get the same type of contract. And what we suggest is that they go to our website, justaskfreeman.com, and join our Safe Money Club.
Yes.
All right, now that's very nice. And download the Safe Money Kit. Now, when you do that, you're automatically in this club. We can send plenty of information on and help individuals who are viewing this this program, especially women, on how to get the right type of insurance for their needs. And also we can educate the viewer on, or viewers I should say, on the 1035 exchange process. Now, you can also do partial exchanges.
Okay.
Alrighty. You could take a portion of the old contract or a portion of the cash value built up in an old insurance policy. Transfer that. Now remember, this is it's a non-taxable event, and it works very, very well. But I would suggest that you get a financial professional that would help you when it comes to these 1035 exchanges.
When you were saying that, I was thinking that's something you would want to navigate alone.
Exactly. You cannot do that by yourself.
No. Well, the next question I wanted to ask you is about bridging the gap between retirement and Medicare eligibility. Mm-hmm. I was surprised to find that the 7 out of 10 current retirees left the workforce before they were eligible for Medicare.
Exactly.
And then you have others who want to leave or plan to leave, but they find they don't have enough money to retire on. Exactly. So we need some help with how do you bridge that gap between when you retire, if you're under 65, and Medicare eligibility.
Okay, let me answer that question for you. That's a good question too, Carolyn. You have in the past, many employers offered a health insurance plan, and it was portable when you retired. That is, you could carry that insurance program with you. The number of small companies, or I should say mid-sized companies and large companies, what they have done is taken the steps to terminate that portability. Now, we've got individuals out here that are under the age of 65. They may have wanted to retire, and they say, well, I can't come out of there because I wouldn't have any health insurance. That has been a deterrent. Exactly. Approximately 27% of individuals would love to take an early out or to leave many years ago from their jobs and separate from service, but they had no health insurance. Now, in 2014, for individuals under the age of 65, approximately 10% of the companies said, well, we're going to terminate or discontinue offering health insurance to those individuals. That's a huge number. By 2015, you're going to have 38% of mid-sized companies and large companies, they're going to terminate the offering of health insurance to individuals or employees. Now, when we look at those individuals over the age of 65, the number is alarming. 25% in 2014, according to this survey, the percentage of mid-sized to large employers indicated they were somewhat or very likely to discontinue their retirement health plans in 2014. 2015, almost half of those mid-sized companies and large companies, 44%, will discontinue offering health insurance to those age 65 and above. But the amazing thing is, Carolyn, is that there is an answer.
What's the answer? Okay,
the answer is affordable health care. This bridges the gap for those individuals who are under age 65. All right, let's take a 60-year-old. He has 5 years before they're eligible for Medicare. Well, there is a solution. The Affordable Health Care Act that was implemented will offer health insurance to those individuals who are not eligible for Medicare, and they can have pre-existing conditions. So there are health insurance exchanges in which our viewers can go and find health insurance if they're under the age of 65 and not quite eligible or have not reached eligibility for Medicare.
Okay. Well, the next topic is about IRA rollover. You have people that retire or they leave their job and they want to roll their IRA over, but they're afraid of a big tax liability. Mm-hmm. So what does a person do when they're trying to do the IRA rollover and trying to avoid the heavy tax liability?
All right. I often recommend that you do go through the process of rolling over qualified dollars. Let me define that. I have just a minute or two to define that. That's pre-tax money that goes into thrift savings plans, often referred to as TSPs, your 401ks, 403bs. These are employer-sponsored retirement accounts. Now, there are restrictions on these retirement accounts. Number one is that if you get a distribution, request that, there's a 20% withholding. There is a 10% tax or a penalty if you withdraw these funds from that qualified plan before you're 59 and a half. All right. Now, the good thing is that you can roll these funds over into an IRA. And in that IRA, some of the restrictions are minimized. And number two, if you're over 59 and a half, you could take a withdrawal without the 10% penalty. Now, we're going to take a short station break, and we'll be right back after these special announcements. And on the other side, we're going to continue our conversation about IRA rollovers. We'll be right back.
Filing for Social Security online is a lot easier than relearning the Watusi.
Well, welcome back. You're watching Skills to Pay the Bills in today's segment of JustAskFreeman.com, and Carolyn and I have been focusing on many areas of concern when it comes to protecting your assets. Right before the break, we left off on discussing the IRA rollover. So let's elaborate a little bit more on that, Carolyn.
Okay.
Alrighty. Something else too, when you receive a distribution from a qualified plan, employer-sponsored retirement account, and the monies are in hand, the dollars have been sent to you. And as I mentioned earlier in that last segment, you may experience 20% withholding. If you're under 59 and a half, there's a 10% penalty for doing so. But suppose you have these monies come to you. You have 60 days in order to roll these qualified plans or qualified funds into an IRA. If not, it will be taxed as ordinary income, and you receive a 1099 anyway.
That's what we were trying to avoid.
Exactly. So you have 60 days to do so. I like the fact that you can roll over monies from the qualified plan into a Roth IRA. There is no limits on the amount of money that can go into a Roth. The limits have been lifted, and there's a 5-year holding period. And of course, if you're beyond the age of 59 and a half, the distributions are all tax-free. Something else I want to mention too, we're going to talk about that, the required minimum distributions in a minute or so. At age 70 and a half, once you've rolled over these monies from the qualified plan into the IRA, at age 70 and a half, is mandated, you must start taking monies out of this IRA or tax-deferred account, because I guess the Treasury Department don't want you to have your monies tax deferred indefinitely. So there's a distribution that is mandated at 70 and a half, and you take out more and more each year. So I want to leave this this segment and go into discussing required minimum distributions for you. Alrighty.
Okay. Well, you know, RMDs or required minimum distribution, we hear that a lot, but sometimes we don't know what that means. And it's actually an annual amount that must be taken out.
Exactly.
of your 401ks, when you have 401ks, 403bs, self-employed accounts, it must be taken out when the person reaches 70 and a half.
Exactly.
And the first withdrawal is April 1st, following the year the person gets reaches 70 and a half.
Exactly.
But the question is, what about a person, are there employers who will allow employed account owners to continue their distribution until they stop working, even if they have reached 7 and a half years?
The answer to that is a big no. Now, if you're self-employed, all right, and you have a qualified account, like a self-employed employed 401k, then you can work beyond the age 70 and a half without taking the required minimum distribution. But for the most part, those plans you just mentioned,
Yes.
mandatory distribution, taxes, ordinary income, and each year you must take more and more of your more distribution out of your particular pension plan. I shouldn't say pension, I should say your qualified plan. Now, you mentioned the April 1 date. What is interesting about that, Carolyn, is that at 70 and a half, you have up until a year after you turn 70 and a half to take that mandated distribution or required minimum distribution, which I'll refer to from this point on. But the interesting thing too is that if you wait until April 1st, a year after you turn 70 and a half, you end up required to take 2 distributions from your IRA.
And that could throw you into a higher tax bracket.
Exactly. You can, and so what you can do is, if you go to our website, justaskfreeman.com, download the free Safe Money Kit. You can get all the information you need joining our club, the Safe Money Club, and we'll send you all the information you need about required minimum distributions. Now the thing is, take your RMD the year that you turn 70 and a half. Therefore, that could minimize your tax bite. You have to take the required amount of money out of your IRA or qualified plan prior to, on or about December 31 of each year. Now here's the kicker. What if you do not take the required minimum distribution? You know what happens?
What happens?
Okay.
Heavy penalties?
Heavy penalty, a 50% penalty on the amount that you should have withdrawn. So it's very, very important that you take the required amount of money each and every year as mandated by the government to take these funds. All right.
Now, Freeman, we've done a lot of talk about employer-sponsored plans, but then what about the self-employed retirement plan? How does that work?
Okay. Well, a self-employed plan back in the 70s and the 80s was referred to as KEO accounts and HR10s. Today they're referred to as SEP IRAs, 401k plans for employees, or I should say for the self-employed. There's others called simple 401k. These are established by an individual, or it's sort of separate from an entity or a company. The amount of monies that can be placed in these self-employed 401ks, you can max it out at $52,000 per year, unlike IRAs at $5,500 if you're under the age of 50, and you get a $1,000 catch-up at age if you're 50 and older. The contributions to a self-employed plan can also be tax deductible up to certain limits. These contributions, along with any gains made on the plans, will accumulate tax deferred. Now, here is something I found. The withdrawal rules for a self-employed retirement plan mirrors the regular traditional IRA or traditional 401k distribution mandate. At 70 and a half, you must take the required minimum distributions each and every year. That's the law. Otherwise, you would incur the 50% penalty, just like the retirement plans that we had discussed earlier. Something else too, the deadline for setting up a self-employed 401k is December 31 of the year in which you open it or you start the plan. Unlike IRAs, you can wait until August 15th.
Yes.
Or during the time you file your tax returns. So there's a big difference there. But what amazed me, Carolyn, is the fact that you have to take an RMD from your self-employed 401k.
That surprised me.
That surprised me too. All righty. Speaking of 401ks.
We're going to talk about the Roth 401k. Well, you know, 401ks have dominated the majority of employer-sponsored plans, which are funded with the pre-tax contributions. Now, the Roth 401k, the difference with that is that it's funded with after-tax money.
Exactly.
And allows people to enjoy a qualified tax-free distribution until they reach the age of 59 and a half. So, Freeman, what would you tell our viewers about the Roth 401k if they feel that the retirement would put them into a higher tax bracket?
Well, I would recommend that they talk to their tax professional because this is when you convert traditional qualified monies in a 403B or TSP or an IRA. This is a taxable event. Now, before clients come to see me or have come to see me, I've noticed that they took distributions and to start a 401k. That is a Roth 401k. But they took the money from the wrong place. They took dollars from their IRA, which is a double taxable event. The IRA is taxed as ordinary income. Then they started the 401k, which is supposed to be after-tax dollars. So therefore, they run into some tax problems doing so. Well, you can resolve that issue. Again, you go to our website, justaskfreeman.com, join our Safe Money Club. It's absolutely free. As soon as you download that Safe Money Kit, we will send you all the information you need about what a Roth 401k is. And you know, it is very smart to open up a 401k because it's very simple. What you do is a Roth 401k is there's a 5-year waiting period.
Okay,
And the distributions will be what they call tax-free once you reach the age of 59 and a half. Now, the contributions to that Roth 401k, it cannot exceed $17,500 if you're under age 50, or $23,000 if you're 50 or older. Now, you can also have a Roth 401k and a traditional 401k at the same time. Now, again, the required minimum distribution guidelines of a Roth 401k work like those of the traditional 401k. You must start taking the distributions at age 70 and a half. And either as a lump sum or a required minimum distribution schedule which mirrors the regular distributions you get from the traditional 401k and the IRA. So if you see the advantages of having tax-free income in retirement, you might want to consider a Roth 401k. So again, I'm telling our folks now to join our Safe Money Club, and we will send to you, once you become a member, by downloading your free Safe Money Kit, you have all the information that you'll need about starting the Roth 401k.
Okay, well, let's go into retirement risks to consider. You know, the road in life is sometimes bumpy, and retirement can be the same. Because the risks don't necessarily stop when a person stops working. So would you elaborate more on retirement risk?
Sure. That's a good question, Carol. One of the biggest risks is longevity risk. I know that many of our viewers have the fear of running out of money. They ask the question, do I have enough money? Is it guaranteed to be there? The other is inflation. Goods and services steadily increasing. Healthcare costs,
yes.
Unexpected events. Those are some of the major risks that many pre-retirees and retirees face. Again, we have the solution for many of those risks, to minimize those risks. by joining our Safe Money Club and getting your free download on your Safe Money kit. And you'll have all the information you need by going to justaskfreeman.com. Well, you know, the clock on the wall says that our time is up, Carolyn. All right.
It's been great.
All right, and I thank you for supporting justaskfreeman.com. So in the coming segments, folks, we'll be interviewing key corporate entities and talking directly with the folks on Main Street right here in this studio. So if you have any questions or comments, please contact us at justaskfreeman.com. And remember, we're here for you. Also, don't forget to tune in to Skills to Pay the Bills each week here on Channel 10. And we'll see you next time.